Many financial modelers, especially beginners, get confused when they see different people using different approaches to model the same line item. For example, I often get this question on trade payables. Should trade payables be taken as a percentage of sales or should it be taken as a percentage of cost? And in fact, should we be taking it as a percentage of cost or should we be using days outstanding? This confusion arises because of a gap in our understanding of financial modeling. People need to understand why they do what they do. And this video is precisely to fill this gap. Hi, I'm Viz and I'm here to provide you deep insight and robust techniques to make you a champion analyst. If you want to become one, do subscribe to this channel. Now coming back to our key problem statement about what is the right approach to estimate payables, let me illustrate that to you through a series of short examples. In the first case, I'm talking about a situation where we've been given precise day-wise procurement plan by the client, and the client has also given us the expected credit period for each of these procurements. The question to us is, if all the amounts are getting paid to the vendors rightly on the due date, how much amount would be outstanding as on 31st December 2025? How do we answer this question? Well, very simply put, if I'm going to be paying all the amounts on the due date, then only those amounts which are due after 31st December 2025 will be outstanding on the end of December 2025. So first we need to figure out the due dates for each of these payments. And that's not a very big deal. We are simply going to add a column here for payment date, and payment date is simply going to be transaction date plus the due date. And what I can do here is filter the payment date column for payments falling after 2025, which is 2026. And let me sum this up. It's 33,939. That's the amount that we expect to be outstanding. Instead of doing it manually, I could very well do this using SUMIFS function. So let me do that here. Equals SUMIFS the amount column where the payment date is after 31st December 2025. Here is my SUMIFS function. I press enter. I've got the answer. Now let's go to the next problem. In the next problem, we almost have the same data that we had earlier with one exception. We don't have credit period for individual procurement. So how do we approach in this particular case? How do I get the payment date? We know that our credit period is somewhere between, let us say if I look at my actual data, it's somewhere between 10 to 20 days. So let's say the range is between 10 to 20 days and I know the average is 15. Even though I don't know precise procurement date for each of the items, let me take the average to be 15 and let me get the payment date using the exact same formula we did earlier. Transaction date plus credit period, except that here I have to assume that all the credit periods are equal to 15. So this is a compromise we are bringing in when it comes to accuracy. This number using the same SUMIFS function, I'm getting it as 34,818. If you look at it, it's not exactly what we had earlier. So, but if I have to calculate the variance, that's 34,818 divided by 33,939 minus 1. It's around 2.6% off from the actual data that we were trying to compute earlier. But this is still better than saying, okay, I don't have credit period, so I'm clueless. We were able to come with something that's within the ballpark. Now let's talk about a scenario where the data availability further goes down. So in this example number 3, I don't even have day-wise sales outstanding. What I have with me is monthly summary. We have again been told that the credit period is 15 days. So what is going to be the amount that's outstanding as on December 31, 2025? Since the credit period is 15 days, what is going to be outstanding is whatever I procured in the last 15 days. But since I don't know the day-wise procurement breakdown of my December number, I can't precisely get that number. So what is the alternative here? We know that in December 2025, we did a monthly procurement of 66,948. And this was done over 31 days. So we're going to find out approximately what's going to be the amount we would have procured in the 15 days. So if 66,948 is procured over 31 days, my daily procurement would be 66,948 upon 31. Multiplied by 15 is going to give me that 15-day procurement. And 15 here is basically the credit period. This gives me an estimate which is further farther from the number we had. In example 2, we saw that the deviation was around 2.5%. This is going further away, it's around 5%, because here we are making two assumptions. Earlier we made only one assumption, that the credit period is uniformly 15 days. Here we are making one more assumption, that is that the sales or procurement in December is equally spread between the first half and the second half, right? So everyday procurement is same in December. That's one more layer of assumption we are bringing in, which is reducing the accuracy further. What we did so far is called a structural model. So structural model is largely driven by logic and theory. It worked so far. But for us to work with the structural model, we need adequate data with us. As the availability of data keeps going down, we will start having problem. Let's see that in the next example. In the next example, we don't even have monthly data. What we have with us is annual data. Annual number is 660053. Again, we've been told that the credit period is 15 days. If I apply the same logic, that last 15 days sales is what is going to be outstanding. So if over 365 days we sold 660, what is going to be the sales in the last 15 days? Or in this case, actually it's procurement. So 660053 divided by 365 multiplied by 15, that number works out to 27,125. And the variance here, it's way away from what we worked out with all the data in our hand. It's 20% away. Why is this model failing? The reason is because this model here assumes that procurement is spread uniformly through the full year, and that's obviously wrong. We can see here that most of the procurement happened in December. December is our seasonally biggest month when it comes to procurement. So obviously assuming that what I procured in December is at par with the past is going wrong here. So how do we tackle this problem? So to tackle this, we'll move away from structural models to empirical models, or what we also call as statistical models. Let me illustrate that to you with the next example. So in this example, we have not even been given the payable period. We've been given purchases, and we've been given historical data for both purchase and payables. We've also been given sales data, and we've been told to take inference from the past to arrive at payables for 2025. When we had credit period, what we did was we took payables as purchases times credit period by 365. It didn't work out very well for us because there was a seasonality factor in procurement, and therefore this ratio did not really help us. Let us for a moment assume that there is a seasonally adjusted credit period number. There is a proportion. And let me denote this as X. So X will be the credit period by 365, which is adjusted for the seasonal variation. So my payable would be purchases times X. So if I get this X, I can very well get my payable as purchases multiplied by that X. But the only question is, what is that X? We don't have this data. What we're going to do is, we are going to infer it from the past. So I'm going to calculate the value of this X. This X is basically purchases, or rather payables by purchases. So payables upon purchases, if I calculate it for the last few years, so 2021 was 5.12, let me copy paste. It's hovering around the 5% mark. So I can directly take it as 5%, or I can take it as an average of the past. When I take it as an average of the past, this number comes to around 32,544. This 32,544, when I compare it with what we originally got, where we had all the data, is around 4% mark away. So the variance is 4%. It's not accurate, but it's still within the ballpark. It's not too bad as what we saw earlier, a 20% variation, right? So what we are doing here is a statistical approach, because obviously there is no such thing called as seasonally adjusted credit period, right? An annualized credit period. So what we are trying to do here is, we are trying to find a factor which takes into account my credit period as well as the seasonal variation by looking at the past. We are making one implied assumption here. The implied assumption here is that the seasonal variation in procurement as well as the credit period will be more or less same in 2025. I mean, 2025 number will be more or less same in line with the past periods. That's an assumption we are making here. If for any reason you think that's not true, then we will have to come up with a biased estimate for this payable to purchase ratio, which can be a few points higher or few points lower, depending upon what we think is more likely to happen, right? So in this case, when we assume that the seasonal variation in credit period is in line with the past, there is no major fluctuation, we can very well apply this ratio. And what we are doing here, as I said, we are moving towards a statistical approach to arrive at this particular coefficient. But why would somebody want to take payables as a percentage of sales? Let me illustrate that to you with the next two examples. In the next example, I have not even been given purchases. I have been given sales data for 2025. I have been given purchases and payables data along with sales data for the last few years. Now we know that if I have purchases data, purchases times the payable to purchase ratio will help me get the payables. But how do I get purchases? The problem tells us that purchase directly depends on sales. If that be the case, then my purchase should be sales times something. So let's call it as B. So sales times B will give me my purchases. But what is that B? How do I find out? If that was, let's say, 75%, then my sales would, or rather purchase would be sales times 75%. This is basically my cost ratio. What percentage of my sales goes towards the cost? I don't have this data. So what I'm going to do is I'm again going to infer this from the past. So this number again is basically, this B is basically nothing but purchases by sales. So let's take the number purchase upon sales. It was 80% in 2021. Luckily for us, it's been on that range for last 4 years. So that gives us more confidence to take a number similar to 80. So let me just go with average of this. Average of the last 4 years, that's 79.9%. So now I have a purchase number and I have a payables number. In this particular case, I'm making three assumptions. Earlier we made two assumptions in the earlier approach, where we assume that the seasonality of 25 is at par with the past data and the payable period also is in line with the past data, no major fluctuations. Here we are also making third assumption, which is the purchase to sales ratio is in line with the past. We can't do anything if we don't have much data given to us. This is a kind of an assumption we will have to make. And that leads to a further reduction in our accuracy here. If you assume that purchase does not change at all, I mean purchase to sales ratio, this cost ratio is not going to change at all, then we could have actually bypassed the entire purchases. Let's see that, because sales drives purchases, purchase drives payables, which means indirectly we can say that sales is driving payables. And we can also mathematically find it out. See, what we did was we took sales multiplied by the cost ratio, which is purchases by sales, to get purchases. Then we multiplied it by payables to purchase ratio to get payables. So the purchase in the numerator and purchase in the denominator here can offset each other or will offset each other. And essentially, therefore, payables can also be taken as estimated sales into payables by sales, right? So let's try that here. If I'm going to take it as payables upon sales, this is the ratio I'm going to derive for the past. Payables divided by sales, 4.1%. For 2025, let me take it as an average of the past. So that's 3.9. So if with this I'm going to estimate the payable, that's going to be sales times 3.9%. Which is more or less within the mark we had earlier, close to the 32, 195, 32, 202, pretty close to each other. And the variance is also very much within that range, right? So when you don't expect the cost ratio to change, we could as well take payable as a function of sales directly. But why it might be appropriate to do it as a percentage of purchases, in case if you have reason to believe that the cost ratio could change. In the previous case, I do have the ability to play it around. Let's say for any reason I think there is a margin pressure and the purchase to sales ratio could go to, let's say, 82%. I can apply my biased input to this 82 and that will directly change my payables. In this case, if I have to apply that, it's not very easy for me to figure out how much will the cost ratio change and therefore what will happen to the payables to sales ratio. It's not very easy for me to figure out and factor in. But if we don't assume the cost ratio to change, payable to sales ratio is absolutely fine as well. But what we need to understand is the more indirect the relationship is. In this case, it's completely indirect. In our very first example, the relationship was very direct. What will be outstanding? Whatever is due after 2025, that's going to be outstanding. It was very direct. Then we had to bring in approximation with credit period. Then we had to bring in approximation about how the procurement is spread across. Then we brought in approximation in terms of by bringing in a combined metric, a statistical ratio here between payables to purchases, which factored in the seasonality as well as credit period. As we add more and more of these indirect metric, our calculations are going to suffer, our ability to accurately forecast is going to suffer. But when you don't have so many variables that are given to us, we will have to adopt this approach. Before I wind up this, just one small clarification. When I say statistical approach, it doesn't mean that you need to use advanced statistical techniques. In this case, in fact, let me illustrate it to you. If I was going to estimate the payable using regression analysis, I could be very off. So I'm using Excel's built-in function called forecast.linear, which is payables using forecast function. Let me just show that to you. So if I'm going to put equals forecast.linear, which uses linear regression, and I'm going to say, for this sales, find out what would be the payables given that past payables and sales were as follows. This number comes to 29,870, which we very well know is much farther from what was supposed to be our original estimate, right? So regressions and more advanced techniques, for it to work correctly, you will need to have large data set. And one clarification here is data set, when I say, I'm meaning in two conventions. One is number of variables, purchases, sales, payable ratio, seasonality factor. These are all variables. The more variables you have, the more structural models you can build. But for a same amount of variable, let's say, for example, I'm talking about payables to sales ratio. This is one variable. If you have more data set, let's say going back to last 40 years or 40 months, 60 months, if I have more data sets that way, then I can build more robust statistical models. But when you have only a handful of data points, the more advanced statistical approach you use is not going to necessarily give you more accurate answer. We will often stick to simple averages like what we did here, right? So we've had a pretty long discussion. What is the key takeaway I want us to have from this? Finance is not a pure science. Here there is no such thing as correct formula. What we have here is an appropriate equation. So what is the right equation or appropriate equation, or what is the appropriate framework for a given situation? That's what we have to decide. And that will vary based on situation to situation. When you have more granular data and more variables given to us, you can go for structural models like what we had here. As the number of variables given to us keeps going down, we will have to move gradually towards, you will take approaches which lead to some amount of approximation, and will gradually move towards a statistical model where we are trying to find out relationship between two variables which have some level of interactions between them. And that's all that you need to keep in mind while building a financial model. I hope you found this video insightful, and I hope you liked this video. Do click the like button in case if you really like this video, and do share the video with your friends and your colleagues who you think might be interested with this video. And don't forget to subscribe to our channel. Thank you very much. See you. Bye-bye.